Hi there. Today we'll explain how selling business shares before you die can affect inheritance tax and why careful planning matters.
Imagine a highly successful UK business founder in his 60s. After decades of building an unquoted trading company, he is preparing to sell it for £10 million to secure his family's financial future. The conventional logic is straightforward. Cashing out is the safest way to lock in that wealth and eliminate any ongoing business risk. But under the new UK tax rules, this exit strategy triggers a sequence of tax charges that can leave the family with significantly less capital than expected. Two distinct tax forces drive this erosion. First, an immediate capital gains tax assessment is triggered the moment the sale completes. Second, the resulting cash is later subjected to inheritance tax. For the successful UK director or shareholder, converting equity into cash has become one of the most tax-intensive ways to leave a business. Here at Pro Tax Accountant, we guide SME directors through complex UK tax compliance and exit planning. If you are a UK director and shareholder of a closely held SME valued at over £2 million, the calculations you previously relied upon for retirement are now subject to new variables. The Autumn Budget 2024 introduced changes to both capital gains and inheritance tax frameworks, creating a new environment for business succession. We are going to use rigorous legislative modeling to compare the outcomes of a lifetime cash sale against the strategy of holding business shares until death. Relying on pre-2024 exit strategies often leads to a different tax outcome than many founders currently anticipate. Let's establish the hard legislative variables taking effect in April 2026. The first major adjustment is the escalating capital gains tax rates applied to business disposals. This chart tracks the new business asset disposal relief rates. For qualifying gains up to £1 million, the rate rises to 14% in April 2025 and 18% by April 2026. Simultaneously, the standard capital gains tax for non-residential assets increases to 24%. The second major variable takes effect on the 6th of April 2026. A new statutory cap on business property relief, or BPR. Previously, unlimited business value could pass free of inheritance tax. Now, only a £2.5 million combined allowance receives 100% IHT relief. Any qualifying business value exceeding this £2.5 million cap is restricted to 50% relief. Assuming the standard 40% death rate, this creates an effective inheritance tax rate of 20% on the excess value. Higher capital gains tax on the front end now interacts with capped business property relief on the back end, shifting the final value of a third-party sale. Let's run the numbers. In Model A, the owner retains their £10 million unquoted trading company shares until death. Under Section 62 of the Taxation of Chargeable Gains Act, assets passing on death receive an uplift in their base cost to current market value. This completely wipes out all accrued lifetime gains. Because of this statutory uplift, the capital gains tax due on death is exactly zero. This waterfall chart models the inheritance tax on the £10 million shareholding. We deduct the £2.5 million BPR allowance entirely, passing tax-free. On the remaining £7.5 million, the 50% BPR rule applies a 20% tax rate, resulting in a £1.5 million liability. By holding the shares, the family inherits £8.5 million. Despite the strict new caps, the total effective tax drag is limited to 15%. Now consider Model B. The exact same owner sells the £10 million business after April 2026, realizing the proceeds as cash, which remains in their estate until death. This chart models the capital gains tax hit. The first £1 million utilizes the BADR limit at 18%. The remaining £9 million is taxed at 24%. This generates a £2.34 million tax bill, leaving £7.66 million in cash. Here is the critical flaw. Cash generated from a business sale does not qualify for business property relief. Holding this cash exposes the £7.66 million to a flat 40% inheritance tax on death, stripping away £3.064 million. The net inheritance drops to just £4,596,000. A lifetime cash sale in this scenario triggers a sequence of tax liabilities totaling 54% of the original value. Comparing the two models directly exposes a £3.9 million difference in net wealth. That gap represents the fiscal cost of a poorly timed exit strategy under the 2026 regime. There is no statutory mechanism that traces the origin of your funds. Once qualifying shares are converted into cash, all business property relief protection vanishes instantly. But capturing these tax reliefs requires strict compliance in your corporate environment. Claiming BADR or BPR requires meticulous, contemporaneous corporate records. You must be able to definitively prove your company's trading status and verify your specific voting rights over the qualifying period. HMRC scrutiny on unquoted company valuations and relief claims will now intensify dramatically to enforce the 2026 regulations. The tax math only favors the owner if the underlying corporate governance is flawless. Otherwise, HMRC will reject the relief entirely. What if a business owner wants to step back from the company, but refuses to trigger a sequence of tax assessments that take half of the business's value? There is a proactive alternative, a structured lifetime gift of shares to the next generation. Using Section 165 holdover relief, the owner can transfer qualifying unquoted trading shares while deferring the capital gains tax entirely. The gain is simply held over to the recipient. For inheritance tax purposes, this gift acts as a potentially exempt transfer, or PET. It starts a 7-year clock. If the donor survives that period, the shares are completely removed from their taxable estate. A planned Section 165 transfer effectively bypasses the cash trap, transferring operational control without triggering either the immediate CGT or the subsequent 40% IHT penalty. For estates exceeding the £2.5 million cap, retaining your shares or executing a structured gift is mathematically superior to an outright cash sale. Navigating the 2026 regime requires bespoke, proactive financial modeling tailored to your specific corporate structure. Contact Pro Tax Accountant to evaluate and structure your corporate exit strategy before the April 2026 deadlines take effect. Call us at 07985 689 912. Email us at info@protaxaccountant.co.uk or visit our website. Subscribe to the channel for more expert tax analysis. This video is for educational purposes only. Tax legislation is subject to change. Always consult a qualified professional for personalized financial and legal advice.